Now we are going to see each and every function one by one. Okay, and here the most important function of the RBI is the implementation of monetary policy. Okay, so in the last module, while introducing this topic, we discussed that this monetary policy implementation is the prime function of the central bank. Okay, for any central bank including the RBI, if there is a prime function for the central bank, it is implementation of what? Monetary policy. Monetary policy is the defining or core function of the central bank, okay, including that of the RBI. Okay, so monetary policy is one policy that can influence the whole economic activities in an economy. That's very important. So why RBI's monetary policy is a macroeconomic policy? Because it can influence what? Consumption in the economy, investment in the economy, expectations of the people, okay, about the coming economic event. So from all such angle, monetary policy is very important, as vital part of the macroeconomic policy, and that is the prime function of the RBI. And now we are going to see what is monetary policy. Monetary policy is the policy of the central bank, okay, that is okay, influencing the cost and availability of money by using various instruments to realize certain economic objectives. So each and every part of this definition is very important to understand the nature and the content of monetary policy. Okay, here you have to understand the logic of monetary policy, and literally you should read through and as well as understand the meaning of each and every word to get a good idea and a clear idea about monetary policy. Monetary policy is the policy of the central bank. That part is okay. Influencing the cost. So what is cost? That is that element. We will see it soon. Availability of money. Okay. What is availability of money? Using various instruments. What instruments? To realize certain economic activities. What are these objectives? So when we understand the cost, the availability of money, the instruments, and the economic objectives, we can have a fair idea about monetary policy. Okay, so remember the terminologies we just acquainted here. First one is cost of money, second is availability of money, third is instruments of monetary policy, and the next is objectives of monetary policy. Okay, and we are going to it once more to make it thorough. Monetary policy is the policy of central bank. Influence the cost and availability of money by using certain instruments to realize certain economic objectives. Okay, once more we have highlighted the important terminologies that you have to make it in mind to understand the nature of monetary policy. Okay, what is monetary policy? Monetary policy thus can be termed as the policy of central bank. The use of interest rate, again there is one more variation of that definition. Use of what? Interest rates. And what? Supply of money. Okay, to influence the general economic activities. This is one more definition of monetary policy. Here also we can understand that the RBI should use what? Interest rates, and similarly it should use what? Supply of money to realize the economic objectives. So what additional here compared to the previous definition is the element of interest rate and the element of supply of money. The RBI has to use interest rate and it has to use what? Supply of money to influence what? The real economic activities. And now we are going to see the definition in detail. Okay, each and every element of that definition. So we are fracturing that definition, and here what is the availability or supply of money? It means the quantity of money supply in the economy. For example, the quantity of money in circulation in India, suppose that it is around 23 lakh crore rupees. Okay, 23 lakh crore rupees, including 2 rupees note to what we can say 2000 rupees note, the currency in circulation. Okay, so that is what we mean by supply of money. We can also mean narrow money as well as broad money. So we are just considering only what we can say currency in circulation. Okay, so that indicates the availability or supply of money that we had seen in the definition previously. And similarly there is cost of money. Cost of money is not the money, the cost income for printing the currency, rather it means interest rates. Okay, the interest rate you have to give when you are getting a loan from the banking system, that is the cost you are giving. Okay, that is the cost of money. That means overall interest rate in the banking system. So RBI can set the interest rate, or we can guide the interest rate, overall interest rate, the economy, or that prevailing in the banking system when it is facilitating or it is formulating the policy on what? Repo. You may have heard about that already. Repo, the repo rate, that is the interest rate charged by RBI when the RBI giving short-term loans, even one-day loans to commercial bank. Okay, based on that repo rate, the banks are supposed to set their both lending and deposit rate. So that is a way in which RBI can, what we can say, set the interest rate, overall interest rate in the economy. The cost of money means the interest rate prevailing in the economy. Okay, so there are instruments, and we call them as monetary policy instruments. So whenever there is a policy, there should be some instrument to realize the objective of that policy. And the instruments can be, there are different instruments, a lot of instruments. We are not going to see all and every instrument right now. So the repo rate is the prime instrument. Similarly, there is a liquidity adjustment facility, there is the CRR, etc. So we have mentioned just 3 instruments. There are so many instruments. And now we are going to see the objective of the monetary policy. So the monetary policy is the policy of the central bank, okay, regarding the cost and availability of money by using certain instruments of monetary policy to realize certain objectives. So that was the definition, and we saw what were the instruments. Okay, we saw the meaning of the cost as well as supply of money. Okay, now we are coming to the final element of that definition, that is the objective of monetary policy. Objectives can be price stability, can be economic growth. Okay, RBI doesn't directly mention economic growth, but indirectly it says that credit to different sectors of the economy. And the last objective of monetary policy, the third one, is financial stability. That means banks remain stable. And here, the RBI's monetary policy influences and facilitate economic activities. Okay, so it can influence different macroeconomic variables. The central banks control over what? Interest rate, supply of money, provision of liquidity. That means immediate money to the banks so that banks remain liquid. Okay, ensuring financial stability. So there is no Yes Bank, there is no IL and FS, or there is no Punjab and Maharashtra Cooperative Bank. So ensure financial stability. So banks remain stable. Okay, this influences the general economic activities like consumption. Okay, only if these things are okay, consumption will go up. Similarly, investment and ultimately economic growth. So this is the relevance of monetary policy as a macroeconomic policy, and central bank control the economy through this monetary policy. And now we are going to see the importance of monetary policy. Okay, why monetary policy matters as a macroeconomic policy. Okay, so in the last few decades here, monetary policy obtained primacy as a macroeconomic policy vis-a-vis fiscal policy. So when you are comparing fiscal policy and monetary policy has certain advantages. So sometimes monetary policy more effective in some phases of the business cycle, or in some critical financial occurrences or macroeconomic occurrences. Okay, but in the case of some other occurrences, fiscal policy may be more effective. We are not going to a discussion right now, but we are just elaborating how important is monetary policy. Several schools of economics believe that monetary policy of the central bank is effective than fiscal policy because monetary policy has only small lags compared to fiscal policy. That means time difference between a monetary policy decision and its effectiveness. There are different types of lags. Since we are just following the general studies angle, we are not elaborating such monetary policy lags, fiscal policy lags. Lags means time interval. So here the most important lag is, suppose that the RBI is implementing or announcing a monetary policy decision. Its effectiveness will be there only after few months or few quarters. So this type of lag is big there in the case of fiscal policy, but is slightly smaller in the case of monetary policy. That is one advantage of what? Monetary policy. Small lags, that is very important. Okay, so the proponents or advocates of monetary policy says that there is only small lags. Monetary policy is designed only on the basis of economic rationale. That is very important. Okay, there is no political or democratic compulsions. Okay, like in the case of a budget. Okay, in the case of monetary policy, there is no such political or populist compulsions when the central bank is designing monetary policy. On the other hand, fiscal policy suffers from political popular consideration, so that gives some advantages to monetary policy as a macroeconomic policy. And central banks believe that monetary policy is more effective than fiscal policy, and this says that monetary policy is the only game in the town. This is one phrase advocated by a school of economists called monetarist. Okay, monetarism. The monetarist, an ideology which believe that monetary policy is the superior policy in the economy compared to fiscal policy, and their founder was Milton Friedman. Okay, Milton Friedman. My handwriting is not that much good. It is R, not O. Okay, Friedman. Milton Friedman was the founder of the monetarism, an ideology, a school of thought believe that monetary policy is more superior. That's all about monetary policy, and we will elaborate, we will discuss into the detailed aspects of monetary policy in the next module. So for the timing we are limiting here, we are going to the next function of the central bank.